How do you ensure your daughter has the financial backing she needs for higher education, marriage, or even an entrepreneurial dream? Is saving enough? Or do you need an investment strategy that grows with her future? With multiple options available, it's easy to feel overwhelmed. Should you play it safe with the government backed Sukanya Samriddhi Yojana plan, or would a systematic investment plan SIP in mutual funds provide better returns? Let's break it down and find the best approach for securing your daughter's financial future. So, SSY is a saving scheme introduced by the Government of India under the Beti Bachao Beti Padhao initiative. It is exclusively designed for a girl child's future financial security, offering guaranteed returns, tax benefits under Section 80C, disciplined savings with a fixed interest rate. So let us consider an example scenario. So imagine Priya, a mother of a 5-year-old girl who invests 1.5 lakh annually in SSY. With an 8% annual interest rate, her investment grows steadily, ensuring a substantial lump sum by the time her daughter turns 21. So the accumulated corpus can be used for higher education or marriage. But is this scheme flexible enough for evolving financial needs? Now let's take a look at SIPs. So SIPs are a way to invest in mutual funds by contributing fixed amounts regularly. Unlike SSY, SIPs do not have a fixed interest rate but offer higher returns through market-linked growth. So investing in equity mutual funds can yield inflation-beating returns, making it a popular choice for wealth creation. So in this example scenario, let's imagine Ravi, a father of a 3-year-old girl who invests 12,500 rupees monthly in an equity mutual fund SIP with an expected 12% CAGR. So over 18 years, his investment could grow to over 1 crore, significantly higher than SSY's guaranteed returns. However, market fluctuations may impact short-term performance, requiring patience and a long-term perspective. So what should you choose? So let us find out through key differences and how they impact your decisions first of all. So choosing between SSY and SIP depends on returns, flexibility, liquidity, and tax efficiency. So let's compare it in terms of first flexibility. So is your investment adaptable to life changes? If you see in the case of SSY, rigid withdrawal rules are there. So 50% is allowed after age 18 for education, but full withdrawal is available only at 21 years. But if you look at in the case of SIPs, there is complete flexibility. You can withdraw or adjust contributions based on financial needs. So the winner is SIP because it offers full control over investments. If you look at it in the terms of investment duration and liquidity, like how soon can you access the money? In the case of SSY, lock-in period is until the girl turns 21 years. But in SIPs, there is no fixed tenure. So you can withdraw anytime, but it is best held for 7 to 10 plus years for maximum returns. So in this case, the winner is SIP because it provides liquidity when needed. Now, if you look at it in the terms of risk versus returns, like balancing safety and growth, in the case of SSY, there is a fixed 8% interest rate ensuring zero risk and capital protection. And in the case of SIPs, there is potential to earn 10 to 15% CAGR, but returns do fluctuate due to market risk. So the winner is it depends. So you can take SSY for safety, but SIP for higher returns. And in terms of tax benefits, which one do you think offers better savings? So in the case of SSY, your contribution should be up to 1.5 lakh per year to qualify for 80C tax deductions, and maturity amount is completely tax free. But in SIP, ELSS funds offer 80C deductions, but capital gains tax applies like 10% on gains exceeding 1 lakh per year. So the winner is SSY, which is because it has complete tax-free maturity. So which one do you think you should choose? If safety, discipline, saving, and tax benefits are your priorities, SSY is an excellent choice. However, if you want higher returns, flexibility, and liquidity, SIPs could be the better option. So I will tell you an example scenario. Like imagine Asha and Kiran who have twin daughters. So Asha opts for SSY while Kiran invests in a diversified SIP portfolio. By the time their daughters turn 21, Kiran's SIP corpus significantly outpaces Asha's SSY returns. However, Asha had peace of mind knowing her investment was risk free. So, is it possible to invest in both SSY and SIP? Absolutely. Instead of choosing one over the other, a balanced approach could be more beneficial. In the terms of SSY, you can ensure guaranteed savings for crucial milestones like education and marriage. And in the case of SIP, you can build an inflation proof high growth portfolio for career development, business opportunities, or even for long term wealth accumulation. For example, imagine Suresh and Meera. They are parents of a newborn girl who allocate 7,500 rupees per month into SIPs and 50,000 rupees annually into SSY. By the time their daughter turns 20, they have a risk-free corpus from SSY and a high growth portfolio from SIPs. This well-rounded strategy secures their daughter's financial future with both stability and growth. So if you invest 1.2 lakh per year, like 10,000 rupees per month for 20 years, here's how your corpus will grow based on two scenarios. So in scenario 1, we are going to assume we are going to invest in SIP in mutual funds with the assumed 12% CAGR, and in another scenario we are going to assume that we are going to invest in Sukanya Samriddhi Yojana SSY with the estimated 8.2% interest. So in scenario 1, you can see that our annual investment of 1,20,000 with the expected return of 12% per year for the next 20 years will grow into a final corpus of 96.84 lakhs. But in the same scenario, but with the expected return of 8.2% per year, your final corpus after 20 years will grow into, with the expected return of 8.2% per year, which is fixed return, your final corpus after 20 years would be 60.75 lakhs. We have also made a investment comparison table for you, so you can do a comparison side by side on the presented table on the screen. So the key insights from this comparison is your SIP in mutual fund provides you with higher returns due to market linked compounding because it is an ideal option for wealth creation over the long term. And in SSY, it offers guaranteed and tax-free returns, making it a safer option for conservative investors. For aggressive growth, SIP is preferable. For stable, assured returns, SSY is a better choice. So what is the final verdict? So choosing between SSY and SIP or even deciding how to combine both requires careful financial planning. Factors like inflation, risk tolerance, tax efficiency, and long-term goals play a crucial role in making the right investment choice. This is where a certified financial planner can help. A CFP can help tailor a personalized investment strategy, ensuring your daughter's future is financially secure while also optimizing tax savings and maximizing returns. So, what's your investment strategy? Will you prioritize safely with SSY or aim for wealth creation with SIPs? If you need professional guidance, click the link in the description to book a free consultation with one of our certified financial planners today. And if you find this video interesting, give it a like, share, and subscribe to our YouTube channel. So, thank you for watching.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.